Hello everyone, Chad Frantzen here, and welcome to the Kingdom Finance Show. Today we are going to reveal what you really need to know about the economy, the stock market, and real estate. And we're going to give you action steps to take right now to become a Kingdom Impact investor. It's time to bring clarity out of chaos. Let's get started. Hello everyone, Chad Frantzen. Welcome to the Kingdom Finance Show. I'm really glad you're here. Hey, on today's episode, we're going to jump in and talk about the market. We're going to do a bit of a market update. We're well into October, into the fourth quarter of 2023. So we're going to jump in on today's show and provide some thoughts from some of the research folks we follow and kind of put together our thoughts with where the market is. So, hey, thanks for being a part of the Kingdom Finance Show. I want to personally thank you on behalf of our team. And hey, if you want to connect with us, a couple ways you can do that. Please subscribe to us at the Kingdom Finance Show, wherever you're watching this. We're on Spotify, Apple, YouTube, you name it, wherever you like to watch your shows. But please follow us, give us a like, pass it along to friends and family who have a similar desire to gain clarity out of chaos in the financial world and to make decisions with their business, their family, their finances in a way that will bring glory to God. So again, our thesis is that we can make wise choices with how we run our business, manage our finances, both in our company and our ministries and personally, in a way that does not violate our conservative values or the precepts in the Bible, and still come out okay, still have a diversified portfolio, still have good long-term rates of return, and properly allocated in different asset classes, taking advantage of opportunities when chaos erupts in the market. So that's our thesis. We're sticking to it, and we often refer to that as the kingdom model for investing. We've got a couple of episodes on that. Be sure to check that out if you have not already. Okay, so on today's show, again, we're just going to spend some time unpacking what's going on in the markets. Again, we're into the fourth quarter. Historically, September and October are two of the most volatile market months for stocks and for bonds and interest rates. And so we want to kind of take a pulse on what's going on. And we've been very pessimistic about the stock market. It's had a pretty big run up here, what we like to call a bear market rally, a bit of a head fake, so to speak, on that. The economy has been, particularly the jobs market, has been unusually strong. And that is why the Federal Reserve and Chairman Powell have had to continue to keep rates high and continue to raise them. And in September of last month, we learned that the Fed said, hey, we're going to keep rates higher for longer. So higher for longer. And the reason is because of the job market being resilient and strong, and because we're at a $33 trillion in the U.S. deficit. I'm going to unpack that a little more. Because of that, we have to devalue the U.S. currency. And how you do that is through inflation, right? $1 today with inflation at 3, 4, 5, 6%, whatever it is, does not go as far. So you're devaluing the currency. That's what a lot of people don't realize. Well, gosh, why are mortgage rates going up to 8% now? Why is the Fed keeping their interest rate at such a high level and saying they may increase it more? Well, because the powers that be in Washington, both those in blue and those in red, have no desire to be fiscally responsible. And so we're already well over $33 trillion in debt. And there's only a few ways to combat that, which we'll talk about here on the show. All right, let's jump in. Again, the stock market itself, my opinion, Chad's opinion, is it's overvalued, it's unbalanced, and it's not diversified. So if you're investing in just the S&P 500 index through your retirement account or brokerage account, you may think that you are diversified. Wrong-o, you are not diversified. In fact, let me tell you why. There are about 7 technology companies that are really leading the entire stock market. We used to say it was 5. Now it's actually up to 7. So for those keeping score at home, go ahead and fill in the blank quiz sheets. Tell us who they are. So if you're listening along with your spouse or children and you want to be really smart, just go ahead and tell them. Who are some of the top 7 companies? Your clue here is technology in the U.S. market that are driving the entire stock market this year. Cue the Jeopardy music. Okay. I'm not that fancy, so I don't actually have Jeopardy music. So the top 7 companies that are leading the entire market this year. The usual suspects here. We have Meta, a.k.a. Facebook. We have Amazon. And, of course, we have Google, Apple, Microsoft, and then Elon Musk's Tesla, and NVIDIA, the chip maker behind a lot of the AI. So those 7 companies are driving the entire market. So it misleads you to think that the overall stock market is healthy and that companies overall are doing well. So if I told you that year to date for 2023, these 7 companies, Facebook, Amazon, Apple, Microsoft, Google, Tesla, NVIDIA, collectively, they are up some 58%, depending on the exact day that you're tracking this. And what if I told you that the other 493 companies that make up the S&P 500, that for the year 2023, now again, we're recording this in October, so these numbers vary. This is the data is actually through the end of September 30th, end of the third quarter. The other 493 companies are only up 4%. That's right. You don't have to rewind it. I'll say it again. 4%. The top 7 companies are up some 55 to 58%. And everyone else is only up 4%. Staggering. So again, you may be invested in those companies, but financial gravity says if you have outsized return in just a handful of companies and everything else is not doing well, it is a matter of time before those things come back down significantly on that. In fact, these top 7 companies make up about 34%, so over a third of the entire S&P 500's market cap. Okay. Now, if we go back to the bear market of 2008, we go back to the .com crash of 2000, the top 70 companies then only represented, in 2008, the top 7 companies represented about 14% of the market. And in 2000, the .com bubble, they represented around 19, almost 20% on that. So this is staggering. So 7 companies, all technology, all the big mega cap names, many of which are very woke, very liberal focused in their agendas, make up over a third of the, air quotes, market. So what happens if the AI hype fades? What happens when technology comes back down to reality? It's fascinating. Fascinating what's happening in the markets, and yet most investors do not realize how overvalued, unbalanced, and undiversified they are in typical index investments. Now, let me talk a little bit about the economy. The economy is primarily made up of consumer spending and primarily small business owners, moms and pops, franchises, entrepreneurs. In fact, there's another index called the Russell 2000, and there's one called the Russell 3000 also. And as the name implies, it looks at an index of 2,000 or 3,000 companies, which is a much broader index than the S&P 500. Yes, I'm putting my fifth grade math to work here. And yet the Russell 2000 index, it's what we call a small cap index. Now, again, what I'm trying to educate you on today is taking a pulse on the stock market here in the U.S. here. We're entering in the fourth quarter. We've got a lot of chaos going on. We've got stuff going on with Russia and Ukraine and Israel and the Gaza Strip. We have wars and rumors of wars. We have geopolitical unrest. We have a presidential election coming up. So we need to pay attention to what the stock market is doing, right? And what is the economy implying is going to happen. Okay, so the Russell 2000, it is really a better benchmark for the overall health of the economy. Because I think you would agree with me, if we just looked at the top 7 mega cap tech companies, that's not necessarily a good litmus test for how well the overall economy is doing. If we looked at all the different industries, small, medium, large companies, manufacturing, you name it, right? Now, check this out. The Russell 2000, which is a much better indicator of the overall health of the broad U.S. economy, how much do you think it's up so far this year in 2023? Okay. Well, if you thought it was up any year-to-date 2023, you would be wrong. And I actually thought it was up year-to-date myself. And then I looked at the numbers at the end of the third quarter, and the Russell 2000 index is negative, about 2% year-to-date 2023. Now, I just talked about how the big 7 tech names are up collectively 58%, right? So, the S&P is up year-to-date. I didn't quote that exact number, but the S&P as a whole is up over 10% year to date. The tech names obviously make up the huge part of that. But the small caps, a good barometer for the overall economy, is down 2%. So you might think, what does that really mean? What it means is that the economy is not as healthy as you think. All right. Let's transition to what I mentioned earlier at the top on the budget and the deficit. Current U.S. deficit is like $33.4 trillion at the end of the third quarter. It's obviously higher at this recording because it goes up every second. Did you know that the United States has added some $32 billion in debt over the last 2 weeks, every day for the last 2 weeks? $32 billion every day for 2 weeks. In fact, last week, end of September, the U.S. debt rose $275 billion in 1 day. So clearly, regardless of your political persuasions, Democrat, Libertarian, Republican, this is a problem. The years of a zero Fed rate policy are over because we look at the economy, we look at this debt problem, it is significant. Now, remember, we had a debt ceiling crisis some 4 months ago. We had then Speaker Kevin McCarthy and President Biden agreed to a debt ceiling bipartisan resolution. Well, what that agreement said in the fine print was that the debt ceiling crisis, the resolution, would have an uncapped, unfunded debt ceiling until January 2025, just in time for the next president to be sworn into office. So there is absolutely no incentive for either party to cut spending, and there's no limits on how many trillions of dollars in treasury bonds can be printed. This is a problem. And I'm wanting to unpack this on this market update episode because we have to think very shrewdly as business owners, as people who run ministries, as people who run organizations, for investing our own capital, because there is a reckoning for this. And I want to talk about three things that we see may happen. Now, remember, the deficit's going up at the same time that interest rates are going up. So as you and I know, if you go to purchase a car or a house and you want to get a loan on it, you pay an interest rate. And the more debt you take out to buy a home, the interest rate is based on your loan. So doesn't take much more than a fifth grade math education here. Maybe seventh grade math if you've had to study Common Core and overcome that. But the higher the balance of your debt is and the higher the interest rate is on your debt, you got a problem. It's called debt servicing. And so what has happened since September 20th, when the Federal Reserve announced that they were going to do higher for longer, and they may actually raise rates one or two more times, Treasury bond yields have risen dramatically, significantly, as investors are demanding a higher yield on U.S. government bonds. So it really becomes this never-ending cycle. It's not sustainable. And in fact, the U.S. deficit, going back to about 10 years ago, 11 years ago in 2012, it was $20 trillion. In 2020, it was $30 trillion. So even since COVID, 2020, 3 years, the U.S. deficit has grown by $3 trillion. Now, eventually, this massive and growing deficit is going to slow the U.S. economy. And it's going to be a slowdown that will last several years, potentially even a decade. Once the stimulus money and the other deficit spending wears off, the economy, in our opinion, and we've shared this before, and a lot of friends in the industry that I esteem view this as well, we likely will look at a stagflation environment similar to what we saw in the 1970s. Okay, so little economics 101. What is stagflation? Stagflation means that the economy is growing, but growing very, very slowly, while at the same time, inflation is high. And that's the era we saw in the 70s, where for several years, almost an entire decade, we had that environment. So there's some economic growth, and whoever the politicians in power will say, hey, the economy's growing. Yeah, but very, very little, 1% per year, maybe 1.5%. But inflation is significantly running much higher than that. So you're almost going backwards, even though the economy is, quote, growing. Let's talk a little bit about what can be done with the deficits, how the market is reacting to this here as we're talking about a market update here for the fourth quarter. There's really three things. There's three ways to deal with an unfunded budget deficit. One, politicians can raise taxes. That's not going to happen as we embark in an election year. Two, politicians can cut their spending. That's not going to happen either. We already talked about that it's uncapped until January of 2025. Raise taxes, cut spending, or three, politicians can devalue the currency. So devalue the U.S. dollar. Now, how this is done, I alluded to it earlier, this is done by inflation. So if you're trying to get your arms around, well, why does the Federal Reserve keep interest rates higher? Good grief. First-time home buyers can't afford to buy a house. Mortgage rates are now approaching 8% on a 30-year mortgage. Home prices are still elevated. Why is the Federal Reserve saying they're going to keep it higher for longer and increase it? Because politicians are not going to raise taxes. They're not going to cut spending. And with a $33 trillion deficit that is continuing to grow, option 3 is the only one left on the table. You must keep your inflation level moderately high in order to devalue your currency. So it doesn't have to be extremely high inflation, but it could be keeping inflation at 4-5% for 4 to 5 years. That would devalue your currency by about 20%, give or take. That's what we're looking at. No one in D.C. believes politicians will raise taxes or cut spending in an election year, and the only way this can be paid off is by devaluing the U.S. currency. It's a nice way of saying this. Hey, we're going to let inflation devalue the newly created treasury bond dollars that the Fed issues, or we'll call this printing money. Inflation is going to be a continuing, ongoing problem for the U.S., really for the foreseeable future. We've been saying this for some time. A higher federal interest rate that's held higher longer is really our future until Congress can get their spending back under control. So when you think about making decisions for your businesses, for your families, for your investment portfolios, we need to be thinking in the mindset of rates and inflation are going to stay higher for longer. So how do we adjust? What decisions do we make? Talk a little bit about recession outlook. Most of the indicators that we follow, such as the inverted yield curve or the leading economic indicators, those have both been flashing signals, kind of an early warning system, if you will, that an economic recession will start as early as this fall, October, November, anywhere between really the end of this quarter into late spring of 2024. Now, so that's something we want to keep an eye on. With rates staying higher longer and bond yields being inverted, and all I mean by that is if you go and invest in a 2-year treasury bond, you're going to get paid more to invest in the 2-year bond than if you went to take the risk to invest in a 10-year bond. That's backwards. That's not how economics should work. I talk about that in other shows, but inverted yield curve continues to tell us a major market correction is happening, will happen. It could easily be on the order of 20 to 30 to 40%. Because major asset classes are very overpriced, whether we're talking about real estate, whether we're talking about public equities. So want you to be aware of that. Personally, we're taking a more cautious approach to investing in public equities and real estate. We do believe that as this recession kicks into gear, as we see rates higher for longer, inflation continuing to be stubborn, we're going to see some economic cracks in the glass happen. And certainly the geopolitical events happening around the world just add more chaos to an already pretty tightly wound market in the U.S. So again, not giving you investment advice here, but as part of our market update, my personal opinion is I want to be a little more conservative. I want to stay pretty diversified going into the fourth quarter and the holidays and into the first of the year as we go into the election year. I do think there will be some meaningful opportunities to invest in some high-quality, pro-values public companies which we're going to be participants in. I also think there's going to be some really good opportunities to invest in different parts of the real estate market. But again, you make your money when you buy. You can never time the market perfectly. However, you want to also be wise to not listen purely to what the talking heads at CNBC or in the media are saying, that all is well and it's back to a bull market on that. So in summary, stock market still very overvalued. You're not truly diversified if you're just investing in the index. Those will come crashing down as we enter into a recession, in my opinion, here end of this year as we move through the spring of 2024. Expect rates to stay higher longer, and not even surprised if we see another rate increase here before the end of 2023. Well, hey, that has been our market update. I know I went kind of fast and furious on that. I had a lot of notes I wanted to share with you all. Again, want to encourage you, please follow us on the Kingdom Finance Show. If this raised some questions for you on, hey, I wonder how well I'm diversified in my 401k or in my kids' college savings account, or if you are wanting to create an investment plan to say, okay, how do I prepare for economic chaos that's coming as we enter into an election year? If you want a defined investment strategy that is centered around biblical values with the goal to build wealth, lower taxes, and make an impact, we would love to connect with you at Wealth Builders Investments. So we've got a free download, a free financial survival guide download, which you can get now at wealthbuilders.net/invest. wealthbuilders.net/invest. Go grab that free financial survival guide. It's something we put together earlier this year. It's a good quick read, a good handy reference guide. And if you read that and you would like some personal advice, if you want to say, hey, I would like a consultation on kind of where I am with my business and my family when it comes to financial stewardship, our team would love to connect with you, and we'll offer you a 15-minute consultation. Just send us an email, info@wealthbuilders.net. We'll be happy to connect with you. And on behalf of all of us, thank you for being a part of the Kingdom Finance Show. We'll see you next time. Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Authentic Counsel, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine risk factors and other information contained in the memorandum.